Well, it's my favorite time of the month and actually favorite time of the quarter. We actually get monthly charts. There is so much actionable for next week. It was really hard where to start. So we're going to pack this in. We're going to go broad. We're not going to go deep. And we got a lot of things to focus on specifically about where the money's flowing because it's not really where we think it is. Monthly charts and quarterly charts are a great way to see and just gain perspective. So let's get into it. If we take a look at the S&P in and of itself, you would look at this and go, why is everybody upset? What are the problems? Here's the monthly S&P. And so this is the trend and this is exactly what's happening. We can debate everything, but if we just take a moment and look at this from a 34,000 view, when we start getting into the actual names, it's going to become pretty clear why money is flowing, where it's flowing at this particular time. And we can all see this cup and handle. That's the beautiful thing about technical analysis. After it's done, you can see it pretty clearly, but that doesn't really help us. But if we don't look at the past, we really don't have a roadmap on where we might be going. So that's where it's helpful. So you see the cup and handle here and you can see the push. One thing about cup and handles and patterns, when they break out, one of the easiest things for you to do to gain perspective is to just measure them. So when I run my monthly and then I always run quarterly charts too at the end of the quarter, I'm kind of like a nerd at the end of the quarter. I really like it. But if you measure off from the low point of the cup to when the cup and handle breaks out and you measure up, you'll get a measurement from that bar up on where this could lead. Now this is a monthly chart, so you're getting 36.7%. You do not do points, you do percentages, because the percentages are going to stay the same, but the points would change, right? Because 1,200 points from here to here is different than 1,200 points from here to here. So if you just went here and said, okay, well, where does that put you? Puts you up here, guys. It really does. It really puts you up here. Now this is a monthly chart. But why I'm showing you the monthly chart, we're going to look at a bunch of them, and then it's going to give you a very different perspective on the world, believe me. When you look at it that way, and you realize, oh, we're overextended. You're not overextended. Remember, if you think about these, and people will know this from their O chemistry days, enantiomers, but if you take the equal and opposite reaction of this, if you flip this and took a mirror image of it and flipped it up, that's exactly what we just did there with the measurement, right? So when you're looking at these levels, this is where it's telling you you're heading. Now, does that mean you're going to get there by Tuesday? No. It's telling you that you're looking at a chart here. And this chart is telling you that, hey, we had a cup and handle here and we broke out. And for those that are in the community or in the alpha chasers community or just in general, if you recognize this particular pattern, this is a rising three, up 1, 2, 3, pops, highly definable patterns. You had a breakdown here, you had the reversal. And that's just the ES. Now, there's a lot of reasons why this is happening, a lot. Now, if you're new, welcome. A lot of what we're going to get into today, we're going to cover some older topics that you've seen in the past week. I'm going to refresh them because they're very pertinent to what happened on Friday and what's happening in the market right now. It's pertinent to get there. I look at the world as a stool, meaning this is where I am trading. This part right here, this is my trade. This is where I think of trading. And then I look at the macro, I look at the fundamental, and I look at the technical. And it's very important for people to get that's how I view the world. And the reason that I think it's important is so that when I go top down, meaning when I go something like index, sector, stock, people actually understand why I'm doing that, right? I think that's really important for people to get. Now, what I mean by that is I look at the world as top down. I need to look at the index, then I need to look at the sector, and then I need to look at the stock. I want everything going in my favor as much as possible when I do trades or make investments. And we are going to talk about swing trades in this today. A lot of people think that what I do is the majority of day trading. It's really not. It's about 25 to 35% of what I do, dependent upon market. But that is the macro leg. Now, when we talk about the macro leg, we're talking about, could be something as simplistic as who becomes president and then what does that debate do to the presidency? And we all know that that is important, right? Policy is important. So is Powell and then what they do with interest rates. That is the macro leg. What happens with France's election? Why would that be important for a macro leg and why would that affect the S&P? Well, think about it. If you have instability over there, then money's going to go find a new home. Money doesn't go away. It just finds a new home. It just moves. And then if you take a look here, then you have the fundamental leg. The fundamental leg is going to be how the macro leg affects you. So in other words, if money comes out of, let's say, France, then all of a sudden Hermes, Louis Vuitton might get hit, but Amazon might go up. And there's ways to figure that out. So this really becomes the what, and then this becomes the who's affected by that. And then you get into the when, and the when is technical analysis. Technical analysis is exactly what we're doing now. looking at the past, reading the tea leaves, and then seeing if we can utilize that to make better informed decisions about what market participants are doing and then how we can benefit from that. Important concept for people to get. I would argue that this is really, something like this is really the best way to trade. And I'm going to explain why I say that. If you look at Goldman Sachs, Morgan Stanley, if you look at any major investment bank, they follow this process. They have economists, they have analysts that analyze the stock, and they have technical traders, right? They have all three. They actually have a technical department. They don't have just a technical department. If Goldman could save money and all that mattered was technical analysis, do you think they'd be paying economists? Do you think they'd be paying research analysts? No, you need all three. And so to become a really good trader, like top 1% trader, you need to have a foot in every single one of these pools. You might not believe that, but the people that are at the top of the game do. Now, I'll dive more into that in the top of the game later because there's a lot of misconceptions out there that we're going to cover today, and we're going to NQ here. Now, one of the things about the NQ is you're following suit. And all we're doing now is just looking at these monthly charts and just getting a sense of it. Here's the cup, and then we see the handle, and we see the same exact pattern that happened. And this happened right around when Itchy did what he did with interest rates and said, we're not going to raise rates anymore, and the market lifted. Now, we all remember why that's important. Remember, as they raise rates or lower rates, it affects the equity risk premium. Equity risk premium is how institutions buy stocks, specifically pension funds, which are kind of underweighting equities right now. Now, I got a tremendous amount of requests for updates in the comments, and I always read all the comments. That's why I create the content. Content is created to help inform and educate so you can get better and make better decisions. I hope that comes across. So your comments are greatly appreciated. I try to respond to everyone, but I do read everyone, even the people that are mean. But what you want to see right here is just look at the equity risk premium and what's been happening. Well, since May, you've been bottoming out. I don't think that yellow is going to work, even though I was kind of feeling it. I think the black's better, don't you? So if you can see that black down here, that black line, and then you just see the turn, well, the equity risk premium has been getting better in the market. And that definitely is going to help the technology names. It's also going to help the S&P. But for those that don't remember what equity risk premium is, equity risk premium is defined right here. And this is from Sentiment Trader, who I have no affiliation with, but they did an excellent job here. This shows the earnings yield of the S&P. Remember, it's earnings yield. It's not dividend yield of the S&P. Earnings yield, very simply, is you take all the earnings. And now you see, now you want yellow, don't you? So you take all the earnings, okay? And then if you have all the earnings of the S&P, you take the price of the stocks and then you divide it and you're going to get a percentage. That percentage is going to be earnings yield. That's how you get an earnings yield versus a dividend yield of the S&P. We could spend more time on that. We've gone over it before, but for our purposes, going up is good, and it's versus the 10-year. And that's what you need to take from this. So what do you take from what we're doing? Take the fact that this is going up as a good sign, and that does fall in line with what we're seeing monthly in the ES and what we're seeing in the NQ. Now, every quarter, and it's kind of like a nerd or maybe a boomer thing, but I like to marvel. So I started trading back in like the 90s, like mid-90s, 95. It was like 23, I think when it started, 22 or 23, just out of college. And it always amazes me when I look at this and I watch how I trade stuff day to day. And I'm so into it day to day. It's going to go from 126. NVIDIA is going to go from 126 to 127. Then you kind of take a step back. And this is why it's so important for people to get the pockets of how you're supposed to trade and how you're not just supposed to do day trading, how you're supposed to do all the different pockets. But we'll get into that either a little bit tonight or today rather, or a different time, but you need to learn all of them, but not. But it always fascinates me when I look at this and think about like the silly things that you do, right? And how you're day trading and you're whacking things around, and you take this long-term perspective and you're like, well, what am I doing? Food from thought from someone who's been trading for a while. You know, it's just so interesting. We look at these data points like this. This is a big data point, that's why I'm showing it again. You know, distribution of S&P buyback. You know, one of the biggest buyers in the market right now is just corporations. They're buying their own stock back because they think it's better than buying cash or leaving it in cash or buying someone else's stock. And I get why they're doing it. I think it's great. But we look at these data points and they're important. And it's one of the reasons why you saw weakness on Friday. It's one of the reasons why, you know, the market's going to be a little more volatile. Just like it was in March. If you go back and take a look at mid-March, it was more volatile. You know, S&P, you know, right now I think we're down to over 50% can't buy their own stocks. And it gets worse, right? Here's the 500 number. So by the time you're at the 22nd, you're actually going to be like 80%. And then it goes until earnings start coming out and then they can start buying their own stuff. But this increases volatility. But we look at these data points and then how those data points affect the larger picture. This is why it's so important for you to understand your time frames when you're buying, what kind of trading or what kind of trade that is. But this distribution of buybacks on the short term is certainly something we're aware of. And we've been talking about it for some time, and I would continue on the short term to be paying very close attention to this. When you lose a large buyer, it's a big deal. And there's really no other spot like that, even crude. It doesn't really matter. But when you lose the biggest buyer, you have to pay attention. Even SPR, the Strategic Petroleum Reserves, and we have people out there that are, should they fill the reserve? Should they not fill the reserve? Well, that's entirely up to perspective right now, right? But what we do is we always look at this and look at commodities. You want to see what's going on with commodities because it tells you the health of the market. But when you really look at oil prices, like oil's here and gas is here and this is there, and then you take a look at a 20-year chart on oil and you're like, what are we doing? We really haven't moved. You drop this to a quarterly and it gets even more obvious. Now, obviously, you have the great financial crisis and you have when oil actually plummeted and was negative. Funny story, we were actually back here trying to figure out how we could get warehouses and actually find places to store it when it went negative. And obviously that didn't work out, but it was kind of interesting when it went negative, and should have replaced all the strategic reserves right there, shouldn't we? Anyway, when we look at stuff like this, it gives us perspective. But looking at commodities on a monthly basis is a really good idea, but you need to also look at the internals of commodities because it tells you globally what's going on in the market. Now, the importance of understanding commodities is this. When we understand what's going on with commodities, well, then we can look at the market and say, okay, we know what's going on, and is manufacturing strong? Is it not strong? Do we need goods, right, to make things, to make widgets? And these two graphs to me that I'm about to show you were just so neat. But most commodities are in a bear market, and it's going to be like, oh, okay, are they? And here's the Bloomberg Commodity Index. And it basically what it's telling you is percentage of commodities in a bear market. 20%, greater than 20% below the 252-day high. Now, why they use a 252, I can only figure out why sentiment traders doing that, but there's probably a really good reason for that. But we go back from 1970 to 24. And what we notice right here is we notice from, where you're at to here, and then you get this line, and 50% percentage are in a bear market below their 252-day moving average. And then you would look at that and go, okay, well, wow, that's really something, and that's going back that far. So clearly things are, not going great. And this is the beauty of looking at a chart over 50 years and getting a sense of how significant this is, right? Because you can see here, like these peaks in the great financial crisis, how it was worse, and then how it sold down, and then how it got better. But then we can look at something like this, which is exactly from the same company, Sentiment Trader, going back to 1960. Now we're going back 60 years, and percentage of commodities above their 200-day moving average. And this is why I love data. Like I just love data because it makes things so much easier. If you're looking at a percentage of commodities that are above their 200-day moving average, but are not above their 252 high, well, what does that tell you about commodity? It just tells you commodities are basically flatlining, and that certain commodities are going to go up and certain commodities are going to go down, but as a whole, they're just flatlining. And when you look at the data that way, what does that mean for us? I think it means that you have stagnant growth at best. Now, we all know what happened in Germany, and their manufacturing is just plummeting, and we're seeing that in France too. We're having a little bit of an uptick here in the US, but overall, we are seeing manufacturing plummeting. If manufacturing continues to plummet, then commodities will continue to plummet, right? We will have less demand for it. I think that this is more of a warning sign, even though they're trying to make it out to be something, fairly decent here. I think that you're going through a period of, people use this word stagnation, stagflation. I don't know what you want to call it, but it seems to me that commodities, for all intents and purposes, are going sideways. And this is a little different. And people would say, well, why? Okay, always in the comments, it's, well, why are you showing me this and how do I profit from it? My process here is to get you to think how I think, or at least show you how I think. Maybe you don't want to think how I think. But the whole purpose is, once I get that, at least if you can understand where the process is. So in other words, people are looking at oil right now, and they're saying, oh, well, we're going to break out, and this is the time to get involved in oil. And then you just take a step back 34,000 feet. And this is what's so important about what I'm going over with you today. You look at it and go, are we? Well, maybe we're going to get up to 85, 89. Well, this and that. I mean, we have two wars going on right now, guys. You have two wars going on. We're moving troops around. You have the current president that has to fill up the SPR. You have the possible next president saying, and I don't care about your comments, but don't even drop them below. I don't even read them. I guess get rid of them. About politics, I just don't care. So if you look at it from a perspective of what's oil going to do and how you can make money off of it, great. Other than that, it's a waste of your time. But if you think about it, okay, let's say he puts tariffs in. Okay, so what does oil really do? I don't know that it's going to do anything. I mean, I think if you took a step back and just looked at oil and said, okay, We're between this range right now, and we're staying in between that range. So when it gets down to here, wake me up. And when it gets up here, wake me up. And then other than that, leave me alone with it, because I don't really think that there's any true value in looking at that. And I know a lot of people are looking at the energy names and things like that. I would think that if you want to look at the energy names, I'd be looking at small cap energy names, and we went over that on Thursday. As goes NVIDIA, goes the NASDAQ, according to Goldman and JP Morgan. They've both made that statement, and I think it's a valid statement. Now, why am I showing this chart? You'd be like, oh, it's straight up, it's so obvious. I see a crack, and I just want to talk about the crack that I see, and it, obviously everybody knows I'm in love with NVIDIA, but I do see a crack, and I do want to talk about it. Now, that is a 23.5% line, and that's not the line we're going to use. What I do is I go here, and I use the demarcation line of 50. And 50% is not a fib level. People always ask me how I get this, and it's just right here, and then it's just the fibs. And then I just drop the 50 on, but 50 is not a fib level, but they keep it on there, which is nice. If you want, you may want to follow me on TradingView, as I'm going to post more stuff there. And also for those that are on the waiting list to get into the Alpha Chasers community, I am sending out wait lists and the invitations. So please be aware of that. Once the invitation goes out, you have 5 days. And then we go from there. Let me just move on. But just FYI for those that are emailing me about that. If you take a look here, 126.5, I see a sign of exhaustion. That's what I see. But I will always go and look at stuff like this too. Like I'll go and drop the mark in and just go, okay, am I seeing anything here of questions? Now, a lot of people don't have access to DeMark, and that's fine. But I have like a 13 here on a monthly chart. That's not great. Okay, that's a sign of exhaustion. And that's actually how I use DeMark. I don't really use it so much to trade all the time, but I will use that and go, okay, yeah, I'm a little sleepy up here. I'm a little tired. We ran a long race, so maybe it's time for a break. And I think you're seeing that break. Now, NVIDIA in and of itself, I'm going to dive into for a second. And you may notice that the format of this is a little different today, because I'm really trying to pack this in and make it actionable, because people will look at these monthly charts and go, I don't understand. It's important to get where you're at. See, one of the key things that you do, and I always put this out about anchored VWAP. I have a tool right here, and here's the anchored VWAP that's on that tool. If you ever want to have this tool, it's right down here. It's that little star button. But what you do is you just go on any one of these, and then you just star them. If I take that off, it goes away. Oh no. And then you just click it and you put it right back, right? Now you learned something. I love it. So once you have that marked off here, what is that telling you? That is telling you that everybody that's in from that peak is down. Now, where this gets really interesting is we drill down into time frame. And this is really important to get. When we look at these time frames, this is what we wind up with. There's your peak. Now look at what they're doing. Every time the peak gets to that level, they're selling. Every time. As a matter of fact, they caught me here again. I tried here once and they pulled the flim flam and I got out. And this one was really easy to get out of because you have a doji. And we all know that dojis are signs of what? Uncertainty, right? We all know that. So when you see the doji and then you undercut that, it's time to go. They don't want you at the party. You lost your invite. And so gap down runs right into it, rejection. And then you'll see it here too. And this was like such an easy short if people wanted to do it. But up, down, retest, and then boom, you broke if you're doing the day trade. So again, why would you look at monthly charts? What's the value in that? Well, now you know exactly if you were taking the long or short side, what you should be looking for from this trade, right? All from looking at a monthly chart. So hopefully you can see how that's all tied together. Now, just because NVIDIA is getting sleepy doesn't mean that everything is, but again, I do think it's pertinent to look at these monthly charts and just look at what's happened. And now we do have this doji sitting here on the socks. And all I want to do really with these is I just like marking them off and just objectively going, okay, well, where are we? 245 is that level, which you're at 50%. That will become a demarcation line for me to start paying attention to, are the people that bought last month buyers or sellers? And sometimes to me, it's really just that simple to look at the world and just kind of get a sense of it. I do think you're seeing the semi-caps being bought a little bit more, but overall, I think you're seeing rotation in that sector. This was a fascinating graph, and hopefully you can see what I'm doing here where I'm working in things with the actual charts. Hopefully you're getting that. Hopefully by this point you are. A significant number of relatively highs over a brief period. Okay, so they keep making highs over and over and over again, right? And apparently that is good, and it is good. A 3-year high on the index. Okay, great. S&P Information Tech is at what? A 3-year high on the index. Great. Multi-months relative, 13 out of 21 sessions. Okay, 13 out of 21 sessions are higher. Great. And that's better than 22. It's better than 23. And they're showing you these peaks. Is this a sign of exhaustion? This is a sign of exhaustion in a very short window. It is. There's no doubt about it. What usually happens with signs of exhaustion? This is what happens here. If you take a look at this chart, if you looked here and you looked at these levels, all right, and say, well, what happens? Well, here you came down. Can you use this? To me, I don't think you can really use this part of the chart. I'll say it with me at this point. $1.7 trillion was injected into the stock market. That's why everybody here that was trading that thought they were a genius is probably now back to actually saying, oh, trading doesn't work, technical analysis doesn't work. But again, if you're looking here, yeah, I think you have to look at these data points. I do think you have to look at these data points and say, is this something worth paying attention to? I think you're going to get anomalies from it. I think if you use it as a be-all, end-all, you're going to have an issue. How would I use this? Because people will say, well, why show something and not say how you're going to use it? I think you're seeing rotation. I've explained this rotation for probably 2 weeks now, what sectors you're rotating into, and we're going to cover some of that in a bit here. But I do think that this is important to get. I do think that when you get exhausted, you get wild moves, just like we showed with NVIDIA when it gets to peak VWAP, that becomes an area of interest, right? And again, this is, why monthly charts? I'm a day trader. Well, when you look at something like this, where you have IGV, which is expanded tech software, and then you look at expanded tech and software and you compare it to the SOX, and you realize that these are basically the same trade for the past 22, 23 years since their inceptions. And you have your peaks and valleys, and you can see that IGV will be higher sometimes usually, and then the SOX will be higher other times. But overall, which one for the past 22 years has been higher? It's really been IGV. So when you look at this on a monthly basis and then drop it into a daily, see, you go through multiple time frames, and then you look at this disparity and you're like, well, usually IGV leads, but yeah, okay, I could see a battle going on during the day before you look at multiple years or decades. But why would this be relevant? Well, this is pretty clear what's going on right now. It should be pretty clear to everybody that there's a disparity here. If you go back, you'll note that these videos are all linked together, and I'm literally telling you where my head is and what I'm doing. So if you look at this, look at the breakout of IGV. See, something has to catch. Either the SOX is going to drop, or IGV is going to go higher, or both is going to go. And what we're seeing is a disparity of both. If you look at IGV during the day and you look at the SOX during the day, now that you know this, you won't be able to unsee it. It's like the Matrix once you take the right pill. But if you start looking at these kinds of trading, you'll start to see it like just over a daily time frame. You're like, well, what the heck is this? Right? And then you're going, okay, well, that's the SOX dropping as they're buying IGV. Well, how'd you find that? Oh, I look at monthly charts and I saw this huge disparity. And then you'd be like, oh, okay, whatever, dude. But that's how you're finding this stuff, right? And you're going through and go, well, that's weird, because that's usually not the case. And what you'll always find too, this is what I've always found, these disparities usually start when corporate buybacks stop, because then you get rid of the actual underlying buyer, and then you can start seeing where institutions are really buying. That's why understanding when corporate buybacks start is so important. But again, you're seeing way more volatility, and we all know why, the skew. Maybe we'll get into that in a little bit. But this would tell you that you should be focusing on the IGV names, and we'll show you how we identified a couple there. I think it's important to get the concepts. Please comment below on that. But I do think it's really important for people to get the concepts. Why do you look at monthly charts? Who cares? I'm a day trader, and okay, you need perspective. If you don't have perspective, you're going to have an issue. And for me, there's no clearer than looking at the 10-year. Oh, we're up, we're down, they're going to cut rates, raise rates. These guys have not done anything since November except go on lunches and have a meeting every hour telling you about the economy and how they might raise rates or cut rates, yet do nothing. And the entire world moves based upon it. It's absolutely bizarre if you think about it. But where have we really gone since 23? You've been in the same range. And when you understand that, you're like, okay, well, what's the problem? See, I get that a lot with like TLT. People will always bring up TLT to me and go, well, how can you just stay in that? Well, what's changed, right? Since I bought it, what has really changed? Nothing has changed. And you can actually see, even from that date, from the date that he came out and said, we're done raising rates, what's happened? There's nothing to do there. Right? But again, you want to look at this stuff and you're looking to see if you're going to see anomalies. Are you going to see changes? Are we seeing anything with the dollar? Anything of consequence? I could argue that you're holding a major support level. I think that that's valid. I think we could argue that we want to watch the dollar a little closer right now because tariffs, if somebody gets in and they're going to do something with tariffs, then yeah, the dollar is going to go higher. And that is going to lead to international stocks coming, they'll get more valuable, and our stocks that trade globally will come down because a stronger dollar is harder for them to deal with. In regards to Japan, and we keep hearing that they're in a ton of trouble, they have a lot of issues over there. I mean, I see a stock market closing at an all-time high. I don't know what the issue is. I don't know why everybody's upset with them taking control of their own economy. I know why the U.S. is upset by it because they own $1 trillion worth of our paper and they're scared to death. But overall, if you look at this, it's pretty clear what's happening here. You broke down, rallied, came back down. You'll note this pattern again. We talked about this beginning of this video. Up, 1, 2, 3 down, breaks out. I mean, it's not unusual that this happened, since they own the majority of U.S. Treasuries, that this happened in November 1st, right? I mean, you see how it's all tied together? We can always go back to the stool. It's always leaning back to that stool, right? It all comes back to this. Let's pop it back in case you forgot about it. But macro, fundamental, and technical. And then people are going to go, oh, I wonder why that happened. Well, that happened because Itchy said, I'm not going to raise rates anymore. And then all of a sudden we lifted, and now you have this little flag, and Japan's in a lot of trouble. Sure doesn't look like they're in a lot of trouble. Looks like this thing's about to break out and continue to push. So something to think about. And then we keep hearing about the breadth of the market is awful. Well, here's the New York Composite, which is literally thousands and thousands of names, and it's at all-time high. You're at all-time highs. And you broke down and you've tested this area 3 times. But it's going to crack. I mean, if you know when it's going to crack, please comment below so I can act on it. But for now, I've been over this level now for 1, 2, 3, 4 months, and I'm going into the 5th month above all-time highs, and I'm holding. So as I stated, every month I run a screen. Now, when I run that screen, I like to just get a sense of the market. What this one is just wants versus needs. So I take XLY and I divide it by XLP, and you come up with wants versus needs, and you're like, well, why is that important? Well, do you want to buy ELF or do you want to buy Procter & Gamble? Currently, I own both, but what do I want to do here? Which way are we going? Do I want to be looking at Amazon or am I in trouble? See, this also determines the health of the consumer. You can look at anything that you want out there, any economic data you want, and you should in regards to the stool. You should look at that. They will tell you what's going to happen. Why? Because if earnings are going to be good, then XLY is going to go up. If earnings are going to be bad, then XLP will go up. People need toothpaste. People need Clorox. People need soap. Okay, you don't need to go out there and you don't need that new handbag or whatever the crazy kids are buying these days, right? Or Birkenstocks. Someone wears Birkenstocks still. Apparently, the stock was going crazy the other day. But if you take a look at this, this also is a great indicator of the health of the market. Right? Very similar to when I do Qs relative to the SPY. And that ties us into why do you look at these charts? I'm going to show you the list and then you can screenshot it, or if there's a way for me to post that list so it's available to everybody, I have no problem doing that. I'll do it on the main page. I'm just not fluent in how to do it, so you can comment below and let me know. I may actually start doing more videos on the little tricks on TradingView. The price action video that we did, I'll link at the end of this on how to do that one particular trade. That went over really well. So I plan on doing more videos like that. I think they're great pieces that you can take from these videos and go from there. Specifically when I go over, how to use all this data and then find your swing trades, which I'm going to go over in this video. But IPO, why do you care about them? Well, this is the health of IPOs in the market. Are IPOs healthy right now? Yeah, they're getting healthy, and you're seeing diversification. And this is why it's so important to run monthly charts when they close. Because if you look at this monthly chart, you can see that this was my demarcation line, how we tested, couldn't break, tested, couldn't break, tested, I'll say it again, couldn't break. Look at that pattern, isn't that fascinating? Up, down, 1, 2, 3, up, boom, and then we're off. And then what? It looks almost to me like resistance becomes support, say it with me, and then you're setting up to break out. That's what it looks like happening here. So for us, again, that are looking at the market and saying it's going to do this, it's going to do that, maybe it's just tired of going up for a while. Right. So again, what do you take from this? I don't know. Maybe go look at the holdings in IPO. Maybe you'd be surprised at how some of those names are performing. Now, this is an interesting one, and I'm not sure that a lot of people look at this the same way that I do, but I take yield in regards to the S&P. And I want to look at just S&P, the actual S&P, and I just want to look at. And why do I do this? People say, well, it doesn't really work. It's not very helpful. To me, it is, because it's almost like having the way that I do it and the way that I look at it. If I was going to overlay this with equity risk premium, which I showed you earlier, it's very similar for whatever reason and how it moves. So I do like doing that, even though I'm just taking the SPY divided by the TNX. But you see, the other way that they do it with earnings yield is actually better, because you're taking the yield of the S&P. I'm just taking the straight up S&P, dividing it by relatively to the yield. But what I do note is I do note a pattern. Sometimes I'll take these charts, and what I'll do is I'll just drop them into a line and just see if I see anything. And of course you see it as well, I'm sure, but you can see the undercut here and how you're starting to make a higher high. And what is this telling you? Well, this is telling you that SPY is getting ready to outperform versus the 10-year yield. Well, what does that mean? Well, that means one of two things. Either the index is going higher, as we talked about earlier, or yield's going to come down. One of two things is going to happen. Now, when we look at the market, what I like to do is I like to take a look back and look at the New York Stock Exchange highs. Now, why do I do this? And why do I do it on a monthly basis? I just want to see what's going on, and I use it in a line form. And what I'll note about something like this is people will say, oh, we're not hitting new highs. Well, I would argue that you haven't been hitting new highs for 20-something years. If you looked at where you peaked in October, and then 2002, and then you kind of come through here on new highs. You've been doing nothing but dropping, but you are changing. And I think that change is important. And I don't think people are getting it from that perspective. So why do I do this? Because I always want to understand the long term so I can day trade. And I know it sounds weird, but when you understand that and you start seeing these kinds of moves, I can use this data to look for day trades. Well, how could you do that? Well, here's my trend, right? Here's the trend that I'm in. Okay, what happened here? Well, we popped above it. What happened here? We popped above it. How did both of those play out? Pretty darn good. They were pretty darn good signals. What's happening here? Well, we're starting to see more percentage of highs versus the lower lows that we've had. Is this important? To me it is. How do you correlate this to day trading? Well, the same way that we did when you looked at NVIDIA or the SOC. You might start with the monthly and go, well, that's an interesting spot for us to be in. And now that I understand where we were and then why the peak is January and then how that played out, right? I mean, it's not rocket science. Actually, it was March, but it's not rocket science, guys. And then all you're doing is taking this chart and going, okay, let's look at the weekly. Well, are we seeing the pattern? Well, hopefully you see it, but I can just point it out real quick and just go, all right, well, here's the cup, right? You can all see how you low, 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 and then you balance off and then you start making higher lows. And then you're starting to make, what else are you making higher highs. Okay, well then you take this and you drop it to a daily, and then I'll just leave that in for a second so you can see it. And what are we seeing? Well, we're still hitting higher lows. Well, I thought that, the market was, I thought the breadth was bad. It's not really. Is it? Or does it look like it's bad? Because it really, as far as hitting highs on the New York Stock Exchange, you're still doing it. Now, are there signs that you're exhausted? There are some. Now, in regards to the market as a whole, this is market breadth reverses after an extended negative period. And I'm showing this because what we're trying to do is we're trying to say, are we really exhausted or are we not exhausted? I think to some extent we are a little bit in certain sectors. So there's your takeaway. There's your 30-second blip. Annualized return 18.9, 51% of the time. It's a coin toss. Life's a coin toss. Trading, you're just fighting for inches. McClellan oscillator ratio adjusted. Understand that they're using a ratio adjusted count. Consecutive sessions below 0, 20. Consecutive sessions below 0, 20. That's a big number for them over the past 2 years. But what's more interesting about this is percentage of times that this happened when you're hitting a 1% high, less than 1%. So when was McClellan here and then the S&P here, less than 1% of the time. So again, when did you have 20 consecutive sessions below 0 on the McClellan, and then at the same time, you're at a new high? How many times has that happened? Less than 1%. And all their data going back, I think they go back forever. I think they go back like how far their data goes back. But it's really important to get that. You're at a 1% level and you're trying to determine what's going on with the market. And hopefully by looking at this graph, you can see how silly that is. Now, to put this in perspective, here's the S&P, and where am I going with this and what's important about this? That graph that I just showed you, I'm going to just put it in context. Here's where you're flipping, right here, where you're at zero line. How many times has you been at a zero line? Okay, how many times have you been at a zero line? A lot, right? And then you flipped it, okay. How many times have you done that when you're at 3 year highs? Less than 1% of the time. I personally think you're exhausted and that you're rotating. That's what I think's happened. And rotations are very, very important. And I think smart money, dumb money, which we're about to go over, ties that to you. But then you also we're going to have to talk about the skew. Now, as I stated earlier, again, what we're doing here is we're just going over things very briefly. I'm going broad, as you can see, so that you can have a sense of what's going on out there. The key takeaways so far for those that are like, where's he going with all this? Certain sectors are exhausted, but you're rotating. And you're rotating in sectors that have been overlooked. And that is extremely healthy, despite what you see with a lot of the rhetoric. Let's leave it at that. But we talked about this, and we talked about this spread here, and how this spread, the wider the spread, we just want to be aware of these wide spreads between dumb money and smart money. And we don't call it smart money and we don't call it dumb money. We call this institutions and retail because that's how it's calculated. But what are you getting from all this? Where are we going with this and why is it so important? When you see this and they are this close together, they usually, when they're this close together, they're marking a bottom. They are not marking, here you are, that close together. Here you are, that close together. Guess what almost happened here? And I find this fascinating because it ties in with where McClellan is. Are you actually setting up to roll? Do any of these charts that we went over show that you're setting up to roll, or has volatility just increased and we still have buyers? And I would argue that volatility has just increased. That would be my argument. This is from Nomura. They came out with this. I've been showing this for over a month now. For those that have seen this, congrats, because it explains why you're moving the way that you're moving in the market. And people think that the skew is something, it's a warning sign. It's not. You're coming back to where we were in 09, and that's exactly where you are. So what they're going to do is you're going to have a steeper skew, which means more volatility, And what's that volatility going to lead to? That volatility is going to lead to protecting your assets and buying puts. When you have a tightening economy and you're dropping, you don't need to protect it, therefore you get a flat skew. And that's really important for people to get from this, because people are watching this volatility and going, I don't get it. We're going up and now we're going down. So Netflix must be done. We're going to get into a couple names here in a moment, but Netflix must be done. This one must be done. No. It's the skew. The skew's changed. You're getting back to volatility because people are protecting their asset. Really important concept to get, guys. On the educational side, I want to talk about something that most people are overlooking with their trading. So this is a concept that is really near and dear to my heart. One of the things that I don't think people talk about enough is that, setbacks. And I've had them. We all have them. Anybody that's been trading has had a setback, right? You just have. And I think it's really important for people to get that. But most important, there's a lot of misinformation out there about what it takes to actually be successful doing this. So I want to go through this so people get it. This account started, I think, with like 160 or 170. We're doing well. It is a run and gun account. I am day trading. I'm swing trading very aggressively on margin in this account. And this is not how I run everything. It's how I run this one portfolio that's linked to the Alpha Chasers community. All right. This is the P&L on there. There's thousands of trades in there. Trade expectancy is what you make per trade. Everybody that wants to trade should have an idea of when they touch the computer what they're going to make. Profit factor, I'd like this to be closer to 2 to 1. It's at 188. And I'm getting to the important part of this in a minute. But the win ratio, 54%. 53.99, I'm down. And I'll talk about that. Win rate, average win, average loss. Every time you touch the computer, understand this concept. If I'm at 50% and my average win is greater than my average loss, then all I need is more capital. That's it. That's your trading in a nutshell. Just get that concept down. If my win rate is greater than 50% and I win more than I lose, all I need is more capital. And then you're just optimizing, right? It's automatic entry, exit, and then you optimize the trade. A lot of people get this wrong. But there's a couple things I really think that people are getting wrong here, and I want to go over it, all right? I think this is the easiest way to do it. One, any moron can make money. Any moron can make money in the stock market. That's not the point of it. The point is keeping it, okay? That becomes the hard part. What you need to focus on is your drawdown. If you look at this chart on this account, you don't have a drawdown of any consequence. As a matter of fact, I was going through this the other day, talking to somebody about it that I work with and saying to them, my drawdown on my swing trading and my day trading account is less than 10% year to date. From soup to nuts, I don't have a drawdown greater than that in any of those accounts. I compartmentalize my trades, and this account, as I said, is pretty aggressive. But you can see these moves here, and you can see these drawdowns and they might not happen at the beginning of the month or the end of the month, but this is how they happen. You need to keep your drawdowns to a minimum. If you could take one thing away from all of this, if you take a look at your trades on your average winning trade, and you're taking your average winning trade, and you should know what that number is, and you're allowing your average winning trade to go to a negative trade, you're making a huge mistake. Stop doing that. Okay? Go and back test it, and you'll see that it would literally change your P&L on your account. Please take this to heart. Now, you have to understand, not all months are going to be created equal. For example, this month, this was January, and what I did here was I was at a 2. I was trading at win rate of 54 with a 167. Every time I touched it, I made 235. Now you look at February, we crushed it. I'm up $1.23 and 327 every time I touch it. Look at my profit factor, look at the win rate. And it was just on. It was a hotter market. It was an easier market to trade. And we all know February was. And so you're able to hold on there a little bit longer. You're able to make a little bit of money. I mean, I hardly had a losing day in February. It was kind of silly, right? March for me was more of a grind. The P&L came through, but in regards to what you're seeing right here, you have some things that we really have to focus on. So, for example, look at my win rate. I'm at 48.45%. I'm less than a coin toss. I'm at 1.6, but look at my profit factor. Now, this is something I held overnight, and then the way it held, it's actually less skewed than this, way less skewed than this. But it's just the way that the computer read. But it was still a great day for me, but it was way less skewed than that showing. But this is really important because my win rate's here, but here's your win-loss, and look at my trade expectancy, right? So this is a really important concept to get. Even though I'm up, it was just a little more active, but look at how many times I had a losing day in this account. And then I go into April, and I'm showing you this so that you can see this. You see, a lot of people will look at this stuff, and even like myself, I don't talk about when I won the U.S. Investing Championship that much because The people that win that, you don't know if they're buying zero-dated options. You're not looking at a Sharpe ratio. You're not looking at all the things that really matter, the things that actually make you successful at trading. Like, look at this win-loss ratio for April. I'm at 1, and I think I know what I'm doing, and I've been doing it 25 years, and I'm at 1, right? 56%. Look at my profit factor. Every time I touch the computer, I'm making $100, but I grind it out. Okay, and I have some big days there, but look at the volatility of this portfolio versus what January and February look like. See, you're going to have to understand that your process is going to dictate everything, right? And this is a run and gun account. So some days they're going to be not good, and it's the way that it is. That's called trading, right? It's not every day that this is going to work, guys. May, I had a big winner, but this is a little more skewed than here for whatever reasons, the way they carry the positions over. But if we look at May, I'm back to 1.9, win rate's 56%, trade expectancy, I was killing it, right? And then I had a good month. And I just had really good, solid trades that worked out very, very well. Now, it's important to get, again, that this is pretty skewed. It was actually even more here, but I would just take that into account. I like to point out that it was skewed just the way that it was carried over. But again, the profit factor, the win rate, this is important stuff for people to get. And it's more important for you to be here and have a win rate like this and have an average win-loss rate. You know, again, I try to bring this stuff up because people will look at this kind of stuff and go, oh, this guy had a great month or that guy had a great month. You have to understand, did they keep it? Did they keep it? Because a lot of people don't keep it. And this takes you into June. The one thing that you should be taking away from all this is, one, yeah, you're going to have peaks and valleys, like here too is right? So like that was the high of the account. You can see that I'm no longer at the high of the account. That's going to happen, guys. It's called trading. This is called the drawdown. Your goal is to make the drawdown less. Look at the month to month, right? Every month we're going forward. Every month we're getting better. Every month we're making more money. Look at the trade expectancy, the profit factor, the win rate. I'm not even at 50% right now for June, right? But look at my win-loss rate. And why is this, right? The reason that this is, and why I'm hammering this home so much, is because I know that the skews change. So I'm selling directly into winners. Like, I'm selling directly into those spikes. And look at the losses. This is trading. This is what it looks like. Everybody sees these guys out there that are showing, oh, I made this, I made that. If you go and look at them a month later, and you see how much of that they've actually kept, it's a very different story. You know, traders out there that are actually making 8 or 9 figures a year doing this, I'm not talking about the guys that get lucky and make a little money, but the guys that, like the big guys, there are less of them in the world than there are professional athletes. And I think that people really need to get that concept down. So you're always trying to get better, but the idea that this is easy or that you're going to have this huge win rate, as somebody that lives and breathes this, I'm just telling you, it's not accurate. So I hope you found this helpful. I'm more than happy to do more tutorials like this, but I really think that when you can deal with the reality of what actually it takes to be successful at this and actually deal with the fact that you're going to have drawdowns and some months are going to be better than others, then you have a framework in which you can actually build off of. Now, one of the questions I got a lot, and I really hope that you enjoyed when I walk through that. If you don't, just tell me and I can change what I'm doing. But I think it's really helpful for people to get drawdowns and understanding what actual trading looks like versus Candyland. You know, guys aren't all driving around here and just killing it every single day. And it kind of gets exhausting for me to watch it. I know I sound cranky, I get it. But it's important for me, for the people that are working at this, that are wondering why they're not getting it, because nobody's getting it, right? We're all just working really, really hard to figure it out. Even the best are doing that every single day. And when you understand that, you understand what it takes to truly be successful. I want to walk through this Adobe trade. I think this is the best way that I could add value to you. How did I find this Adobe trade? How did we make money on this? How did I find this CRM trade? If you're in the community, you're aware of both of these ideas. You're aware that we're in both of them. You're aware that we're up on both of them. And now I'm going to talk about how we found. So the very first thing that I always do is I look at the markets. I start with index. So I would look at the S&P and I would look at the Qs. And then I would want to make a decision point blank. Do they look good? Do they look bad? It's really that simple. To me, before Friday, they looked good. And so I went with them. I felt comfortable with the markets. That's the first thing. Second thing is I'm always looking for discrepancies. Discrepancies that I can use to my advantage. You're probably going to want to watch this a couple times because I'm going to talk fast to pack it in because this video got a little extensive. But if we look at the stocks and then we look at relative performance of the stocks versus other sectors relative to it, such as the IGV that I went over earlier, we saw a significant difference in performance. Significant difference in performance, right? We can see this significant difference in performance. And as we went over earlier, that's usually not the case. The longer that we go out, right? We can see that. We went back to the weekly and we showed that usually that's not the case, blah, blah, blah. Right, so I have a scenario here that needs to remedy itself. And it's been like this for some time, but this disparity was the greatest. Usually they revert. So now I've gone from index, because I'm comfortable with the index, and then I found the sector that is appealing, which is this. I feel the SOX has gotten ahead of itself a little bit. So now I have my sector, and then I go into what? I go into stock. So then I go index, sector, stock. So then I start looking at them, and what am I looking for? I am looking for liquidity. More than anything else, I want liquidity. I want the big dogs. I want to go where the institutions go. Remember, when you learn a skill set, you want that skill set to be what? Scalable. There's no other way to make a skill set scalable than with trading than do what the institutions do, right? That just makes sense. They're not going to buy the small guys, they're going to buy the big guys. And then you just saw very clearly on this drop that we held, and you can see this level right here. And then this got a little interesting on CRM, didn't it? Here's the 12 or the 22, here's the 12, and here's the 55. And you can see right where we stopped. But what we're trying to do is we're trying to get in, up and in ahead of all that. Let's make that white so that we can see it. So we get a little cross here and we hang out, but what do we get more than anything? What we get here more than anything, and what I'm always looking for when I'm looking for rotation, is I am looking for buying. And we had a lot of buying in these particular names. Now, did we have so much buying that you had to get in right away? No, the way that I viewed it is you had so much buying, you had to pay attention. So in other words, we break down, we hold, we rally, we test the top of that, we hold, which is also a support level. We rally, we flag, and look at the volume coming in there. And then it's on. I use different scans, but then I'm also realizing that I have this huge gap in here. And let me show you what this gap leads to. So if I have a gap like this in a chart, all you have to do is do a fixed range of that area. You can even do from 24 on, but if you do a fixed range from that area on just your volume profile, you can take a real quick look and say, okay, what's going on here? Well, it was very clear in here that once you're through, your major resistance is up here. Well, that gives me a ton of area to play with. Now, Adobe was very similar, but it was no different. But what you had with Adobe and what made Adobe so attractive was you have your rally, your breakdown, you couldn't hold, you couldn't even break down. Look at the flush. Remember, I always mark these bars off. You might want to pay attention to this. I always mark these bars off 50%. You couldn't even stay down 50% on that. To me, that even though it's red, that's bullish. You consolidate across here, and then what are we looking for? We are looking for volume. What do we get? We get volume spikes into there. We get the retest, which has hardly any volume whatsoever. These are just my relative volume scans. And then what are we doing? We're getting more and more buying, and look at the dojis. Dojis are what? Signs of uncertainty. And then from there, once you start pushing, this trade gets abundantly easier. If I cleaned all this off and I went to a bear chart and I understand that I just went index, sector, stock, all I'm going to do is show you something relatively simple where I'm just going to take a body of time and look at the same exact area. And what do you see? Where did you stop? Point of control. So you're trying to get up and in these before something like that happens, right? Now, with point of control, it all depends on where you're marking that level off. So if you came to 24, for example, and you drop it here, you're going to get a different point of control. So it really depends on you, and here why. And it really depends on you how you're viewing the world and what your time frame is on the chart, right? But to me, once I'm in here, I'm aware that the 12-month is right in here, coinciding with this level. So for me to think that we can get to 572, 575, it's not unrealistic. That's it.